Provident Healthcare Partners is a healthcare investment bank that is focused on transaction advisory services. We created this podcast for healthcare executives, entrepreneurs, shareholders, and providers who are interested in learning more about the world of healthcare consolidation.
Hello and welcome to the latest edition of Provident's podcast. This is Scott Davis, and I'm joined by my colleague Dustin Thompson. Also on the line with us today is Aaron Cohen. He's from accounting firm Citrin, Cooperman. Thanks for joining, Aaron.
Thank you very much for having me.
On today's podcast, we're going to discuss the quality of earnings process. This is a process that's integrally involved in every one of the transactions that we run here at Provident, and it's oftentimes something overlooked by business owners and operators. So today's goal is to give an overview of the key components of that process and to utilize the expertise of Aaron and his firm in explaining that. So Aaron, to kick things off, maybe a little bit of a background on you and your firm.
Sure. So my name is Aaron Cohen. I'm a principal and one of the co-practice leaders of the healthcare practice at Citrin Cooperman. Citrin Cooperman is an accounting and consulting firm. We provide audit and assurance services, tax, financial services, as well as transaction services, including preparing organizations for transactions. We have a good-sized healthcare practice here of 35 members that work in different areas of healthcare, including tax and assurance, valuation, transaction advisory, and consulting. We are very focused on healthcare transactions in particular. We work with a good number of physician practices and ambulatory businesses such as ambulatory surgery centers and urgent care centers, as well as hospitals and senior living. Some of the most recent transactions that we've been involved with, we've helped with preparing the largest ENT practice in the United States for a potential initial investor transaction. We have just helped with the acquisition of a hospital by another health system, and we helped to sell a 7-site urgent care facility to a private equity-backed group.
Thanks, Aaron. That's great details. To jump right in, I guess, when a group is thinking about hiring for a quality of earnings, one often question is, do they need to look at a generalist firm or a healthcare-focused firm? Because there's a lot of CPA firms out there. Can you give an overview of, the importance behind a healthcare-focused firm?
Yes. From our perspective, it's absolutely critical that not only are the underlying accounting issues and financial performance of an organization understood by the firm that's providing the quality of earnings analysis, but also that they really understand the industry and some of the industry-based adjustments that may be necessary that a firm will only have the capability to provide if it has a strong understanding of the types of businesses that the client is, as well as the landscape in which it operates and some of the regulatory issues that are impacting it. So yes, we believe it's absolutely critical that the accounting firm have strong healthcare expertise.
Appreciate that. And so as we think about the quality of earnings process as a whole, could you just give us kind of taking a step back, an overview of what it entails and why it's so important to have one done effectively in a process?
So in terms of a quality of earnings analysis, I think it's important to really understand what the goals are of that process. And frankly, the primary aspect of a quality of earnings analysis is to validate the earnings of a business. And what we really mean by that is to determine the normalized cash flow that's driven by the business. So when you have a buyer that has a buy-side quality of earnings, really what the buyer is trying to do is validate the buyer's initial key findings and assumptions that were used in determining the language in the letter of intent around what the purchase price would be. It also helps to identify any red flags in terms of the accounting policies and procedures or personnel that may be problematic for a buyer with that business after an acquisition. And it's really used to identify key observations in which the buyer's initial diligence didn't identify those issues or consider those issues that may have an impact on the financial performance of the company that the buyer is thinking about acquiring. From the sell side perspective, really the goal of a quality of earnings is to educate and prepare the seller for the M&A process, including really explaining the areas that the buyer is likely to focus on when examining the financial performance of the business. And having a sell-side quality of earnings, having an accounting firm to help with that process really helps to establish credibility with potential buyers in terms of the systems that are in place and how highly functioning the business is from an accounting and financial perspective. And it also helps to reduce uncertainty to the buyer in terms of finding some of these errors or other financial issues after an acquisition has taken place. So those are what we see as being the primary goals for a buy side and a sell side quality of earnings assessment. But key to understand is that quality of earnings assessments are really based around helping to substantiate the accounting functions and processes. It helps to provide a stamp of approval that the businesses that are being analyzed, that their accounting is in accordance with what's called generally accepted accounting principles or GAAP, and that the financials that are being looked at by the buyer really are correct and can be used to make decisions as to potential investment returns for the buyer. The quality of earnings process helps to examine key accounting, finance, personnel, policies, and processes. It allows you to know, for example, has the CFO left and not been replaced? What payroll systems are in place? Are there any areas where manual entries are required, which could lead to more human errors, as well as to make sure that the accounting policies are understood and that any significant changes, changes in methodology have actually, that they're understood, and that there's an understanding that if you have a sell-side quality of earnings, that if those are incorrect, that there's an opportunity to fix them moving forward and to be able to discuss those with the buyer.
Thanks, Aaron. And I think one important thing we need to touch base for our listeners is a lot there we were listing both buy side and sell side. So it's important to clarify what exactly a sell side and a buy side is. A sell side is performed pre-marketing in conjunction with the investment bank. This is an expense often incurred by the seller, but it's used in benefit for the seller to maximize EBITDA because we're able to add the add backs in and create more pro formas, add backs often being more aggressive in our EBITDA calculation. Where a buy side is typically performed once we're under exclusivity with a buyer, and it's the preferred partner or quality of earnings firm is often picked by who we're under exclusivity with. So as a seller, we're not able to go out and choose who we want to be our partner in this process. But they both have the same end result of seeking to maximize or seeking to validate what adjusted EBITDA is and proof out the numbers, as Aaron was mentioning, the goal of a quality of earnings.
Yeah, exactly. Appreciate you both for the insights. And so, Aaron, could you give us a feel for where some of the common areas where a business may falter in a QOV process? I'm sure there's some recurring themes here. Anything you see on a day-to-day basis?
Yeah, one of the areas that we typically do see is that a lot of the healthcare businesses, particularly the physician practices, generally have undertaken accounting on a cash basis. And most of the acquirers, particularly the private equity in the hospital and health system acquirers, are actually, their accounting is done on what's called an accrual basis. And so when an acquirer is looking at the opportunity to acquire a business that's on a cash basis, generally that organization is going to want to immediately convert that targets counting from cash basis to accrual basis. So that cash to accrual conversion can be a very tricky part of quality of earnings analysis because in general, particularly when you have a sell side quality of earnings, you're going to want to prepare the business for the potential acquirer and to make sure that you've thought through all of the issues and all the differences between cash basis and accrual basis that will need to be thought through and then developed for the converted accrual basis financials. So, a lot of times you have a buyer that, as I said, that's under a GAAP basis that's audited and that's acquiring a cash basis seller, and the buyer can get a bit nervous. And typically the buyer will ask the seller to convert to GAAP pre-close, or there's going to be a need for a lot of language in the purchase agreement around some of the representations around cash basis. So we find it's more helpful to work with your own advisors on this, and it requires a fair amount of detailed files to really establish the accounts receivable in particular, and the accounts payable, as well as accrued expenses and deferred rent. So that cash to accrual conversion can be complicated and time consuming. And, we also find that, frankly, gathering all the information for a quality of earnings analysis can be time consuming, and there's a lot of information that's typically asked for that we gather, which we do really through the buyer's lens to try to help to prepare a seller for what the buyer is likely to be looking at. And even though it's time consuming to bring all this information and to gather it, the accounting firm that's undertaking the quality of earnings analysis can really help organize that information in a logical way and help the diligence process along. And we can really become an intermediary between the sell side and the buyer. So that gathering of information could take a fair amount of time, but we think it is worthwhile in the long run for a seller.
And one thing I want to touch base on for our user base is a few definitions there. So it was mentioned cash basis a lot, and ultimately when thinking about cash basis, think about the money coming in the door and when it's actually deposited into the bank account from a revenue standpoint. And that's what cash basis is because it's being recorded at that point. Accrual basis would be when the service is provided, because we could provide a service but not collect on that cash till 45 days, 60 days, and that would be accrual basis on a revenue standpoint. And then the other one was GAAP was mentioned, which is generally accepted accounting principles. GAAP includes accrual-based financials, but there are other items within GAAP financials such as footnotes and statements, and this is something that's done while an audit's incurred, but that's not necessary for a quality of earnings. So often during a quality of earnings process, you will hear GAAP referred to, but ultimately we're wanting to get to the accrual financials, which is just kind of spoken with the GAAP process without going into all the details.
And Aaron, you mentioned in your commentary the need to have items prepared for a quality of earnings to go smoothly or quickly. We couldn't agree more. From Provident's perspective, we're assisting on not only a quality of earnings process, but also other areas of diligence such as legal, operational, clinical, and the like. So we're very mindful of getting information as early as possible from groups and having that arranged in a data room in a timely manner. But specific to Q of V work, what are items that you would anticipate every single buy-side quality of earnings group, or even your own group in the case of a sell-side process, would be asking for that a business owner or operator at home may be able to have kind of put in place before they find themselves in this position?
Yeah, there are definitely some areas that we really focus on with the quality of earnings analysis and that are going to be prioritized. One is that we're always going to want to see year-to-date and 3-year trailing consolidated financials. And the reason for that and actually let me define that by financials. What I mean is, a P&L or income statement, a balance sheet, and if available, a cash flow statement. And the reason for that is that we like to be able to undertake a trending analysis to understand the changes from year to year and what may be causing those changes. When you have a business that has multiple different business segments or service lines, so for example, if it's a physician practice that has a physician lab or another type of ancillary, we often also like to see the financial performance by each business segment or service line. If there are any areas of adjustments that management would recommend making to normalize EBITDA, we typically will ask for a fair amount of detail to support those normalizing adjustments. And then for healthcare providers, transaction level billing files by date of service by patient, so really patient level encounter detail, is really critical for understanding the financial performance of the business. And then we typically ask for productivity for healthcare providers. So if you have work RVU data available, we'll look at that. We can sometimes convert and determine work RVUs on our own, but understanding productivity by provider to understand capacity and to understand trends is important. And then we also will want to understand payer mix, how payer mix may be changing, case mix across the business, how that may be changing over time. And then information like monthly bank statements so we can see how cash is going up and down, detailed payroll reports where we can see how employees have been paid and what the trends may be there. Do you have a group of employees that haven't gotten a raise in multiple years? Does that mean that they're in need to be paid a significant amount more in the coming year? And then tax returns and related tax reporting. Those are really the main areas that we're focused on as we look at the quality of earnings. And those will always be the items that we focus on first.
And we agree completely. And often when we're gathering this information either on a client prior to a buy or sell side due diligence or even going to market if we're not doing one, the biggest thing we encounter is this billing data and gathering the correct information. Oftentimes our clients aren't looking at a full billing data extract because ultimately what they care about is the cash coming in the door and learning how to extract all this data so that we can run the different reports that you mentioned in regards to looking at payer mix trends and ultimately some CPT code information or other billers is very key to the process and helping expedite it in a timely manner.
And I think that that's also an area where having significant healthcare experience is very helpful for a potential seller, because firms such as ours have a lot of familiarity with the systems that are being used by the practices or other healthcare businesses, and can actually help to extract that information if the information is not immediately available. So that's somewhere that healthcare expertise really becomes a critical help.
Yeah, and I think that plays well into our next question, which is around the importance of having solid QV representation if you are a seller. I liken it to the idea of making sure that you have solid legal representation, which is another key focus here at Provident, making sure that all the third parties that are involved, much like ourselves, are well experienced and educated on the business model that we're representing, and making sure that we're not only maximizing value but ensuring a seamless process for our respective client. And so this probably touches on some of the themes we've chatted about today already, but just so your color on the importance of having the right QV firm engage and why Citrin in particular is that type of group.
Well, I couldn't agree any more with that, and I do find that often there's an emphasis on having a strong law firm that's involved that has a lot of healthcare transactional experience, but not the same focus from a healthcare accounting firm perspective. And having the right accounting firm helps you to be able to really defend and validate the earnings and really the normalized cash flow that the seller business has, which really has a direct impact then on the valuation that a buyer is going to have for the business, and hence will help to validate the purchase price that's going to be proffered to that selling company. When you have a deal, time is really of the essence, and you don't want to run into bandwidth issues trying to respond to a buy-side quality of earnings analysis as well as all of the other due diligence items. And so having a sell-side quality of earnings analysis that's done, that is done by a strong accounting firm, helps you to streamline the due diligence process, help make it more organized and really shorter for potential seller. And healthcare deals on average can simply be more complex. There are a lot of coding and billing issues. You really need an accounting firm that understands the true operational performance of the practice or the other of the healthcare business. There are issues like ramp-ups of different providers or offices. Revenue and accounts receivable are much more complicated with healthcare businesses and other types of businesses because of third-party billing. So all of this really requires a strong accounting firm to be able to provide the best guidance to you. And it helps to create credibility with a potential buyer when you have a strong accounting firm that's been working with you to help go through your financials and your accounting policies and procedures. And it helps to create goodwill with the buyer that acquiring the target or the seller is not going to create a lot of complex issues for the buyer on a post-transaction basis. So really, the ability for accounting firms to both understand the underlying accounting issues, financial performance, and industry-based normalizing adjustments, this is really key to being able to support your EBITDA and really more realistic and potentially more favorable valuations. And I guess the last thing I'd say is the accounting firms that do very strong healthcare quality of earnings analyses, they really can stand as a resource to you as the seller to answer questions from the buyer, as there are questions that come up during the sale process. So, for all those reasons, we think it's very critical that you have the right accounting firm to help you with the sell side or a buy side quality of earnings.
That's great details. And one thing I think is important is often we hear from sellers, a quality of earnings might cost $50,000 or $100,000 or whatever exactly the number is. And you obviously weighed in all the benefits there. But I think one key benefit is how that can pay for itself, because ultimately they're going through the numbers in much more detail than would be occurring otherwise. So if it is $50,000 and we're talking about a deal ultimately trading around 10 times, all they have to go do is find $5,000 of extra EBITDA, and ultimately they've already paid for their fee themselves. That's not even mentioning all the benefits that the time that Aaron mentioned, speeding up the process, because yes, we are adding in a new layer into the process, so it might slow down our second or third layer, whether it's marketing or the next step, but ultimately it should speed up all of those. So we end up at hopefully a faster point in the long run, which is ultimately the deal closing as our end goal.
Yeah, I completely agree with that. I think oftentimes a quality of earnings analysis can pay for itself in a number of different ways, whether it's helping to increase EBITDA just because that's what's appropriate, and you're working with a group that's helping you to find those appropriate adjustments, or it helps to really facilitate the likelihood of a successful deal being executed because the buyer is able to look at the seller as an organization that has its finance and accounting functions in order, and that they have good representation that has been able to go through and validate the performance of the seller. And once again, we do think that even if there's not an increase in EBITDA that's found, there is the opportunity for the sell-side quality of earnings to handle or eradicate potential red flags in terms of reporting or having the wrong methodology being used for accounting before the buyer gets involved. And when that's not undertaken, when you don't sort of clean up your books and sort of get prepared for the buyer, before the buyer really starts to look into the financial records of the seller in greater detail, the buyer can get worried about the accounting and finance functions of the business, and that can potentially reduce the value to them and reduce their offer. So for all those reasons, sell-side quality of earnings we think makes a lot of sense and generally has a lot of value for the seller company that purchases one from an accounting firm.
So Aaron, as we think about in our conclusion here, just really the core basics of a quality of earnings, what are we looking to protect against and what are we looking to ensure through a well-run sell-side QOV process?
I think that a sell-side quality of earnings has another really significant attribute, which is helping to set better expectations for the seller as to what the likely EBITDA and hence purchase price will be in a potential sale. And the reason for that is because by and large, when there's a buyer that's interested in the seller, they will look at very basic financial information and say, okay, if your EBITDA is $2 million, then we will pay you, let's say 8 times that $2 million EBITDA amount. But the buyer has not done significant diligence to come up with that amount. And they're going to depend upon their own quality of earnings analysis, a buy-side quality of earnings analysis, to determine whether that amount is realistic or not. When you have a sell-side quality of earnings, you really can look at what's likely, what's realistic, through the lens of the buyer, and how to support the highest number, that you can, that's going to be realistic in the eyes of the buyer. And I think this helps to set expectations among all the different stakeholders with a potential deal. And again, I do think it helps to increase the likelihood of a sale actually being executed. And in fact, it can also help, even if you determine that the EBITDA, instead of being $2 million under my example, is actually $1 million, that can help the practice to decide that they may not be interested in selling, and that it may make sense to stop the process earlier without spending more money and time. So either way, I think it can definitely be very useful for setting expectations and hence making a deal more likely to be executed.
Yeah, we couldn't agree more. It definitely makes sense to head things off early in a process if that's truly what makes sense for all involved. So totally in agreement there. Well, Aaron, thank you so much for your insight here. We really appreciate all of the experience you were able to share with us today. Hopefully our listeners were able to learn a little bit about what is a very confusing process for those who haven't been through it and can use this in navigating the preparation of their own business as they think about an exit opportunity. So, Aaron, thanks again.
Thank you very much for having me.